Hey guys, welcome back. We're gonna take another question from Reddit, and it's a general question, but I think it's funny and it's interesting, right? So, where would you invest 100 million right now in real estate? $100 million is a lot of money. So, are you talking about private equity money? So, this is not a small fish, right? Retail investors. So, 100 million is right now in real estate. I'll do private credit. So right now with the banking crisis, there is a shortage of transaction and liquidity, right? So a lot of PE shop hedge funds are starting distressed real estate or private credit funds. Unlike banks, real estate developers or real estate operators understand real estate. So they're going to be the best at underwriting these particular deals better than, JP Morgans of the world and Bank of America PNCs, because that's what they do every day. But there's too much risk in the market with interest rate going up, a lot of fallout, potential recession, muted rental increases. So they would like to play the bank, right? I think if you have $100 million, I'll play private credit. Credit means is you can put in senior debt, mezzanine debt, or preferred equity structure. And it might not be the full senior debt. So a person buying a property for $100 million, and traditionally in a good market, a lender will provide 60, 65%, or even 70% LTV, which stands for loan to value. However, with the current markets, lenders can't stretch their leverage that way. So they might be able to be comfortable to give you 50% leverage, which is loan to value. So what that means is you, as a sponsor or the owner, have to come up with more equity, more cash. But as everyone knows, we're extremely talented and smart. The best way to make money is with other people's money. If the property is really doing well and is self-performing and there's a lot of room for your cash and cash yield. So instead of you putting in the money, you want additional capital. So you're going to go out to these private credit or secondary debt platform. And yeah, the interest rate is going to be much higher because they take on more risk than the senior debt. So as an example, senior debt may take 6%. And they'll give you $50 million. Then you have to come out with $50 million. That's too much. You only want to do $20 million. So then you go to these preferred credit or private credit, such as B REITs, which is Blackstone REITs, or other secondary debt platforms, and they'll give you that 30% leverage as a preferred equity. So then they will charge 10%. So blended, you're gonna be at like 8.5. So when you with your underwriting, your cash and cash or levered cash and cash is still very strong, and you can meet your debt service coverage ratio, which is DSCR. That's how the lenders look at the health of how much lending you do versus how much the property generates and how much you can cover your debt service. So that's how they metric that out. So now if I'm the private equity firm that has a private credit, yes, I put in $30 million. And if you're successful, if the sponsor or the operator is successful, I still get my 11%. However, if you mess up, oh shit happened, then I can step in and I just got a 20% discount. And because I'm a private equity real estate company, I am savvy at operating. I might be vertically integrated, so I can take over the property at less basis. And because they are private credit, it's not regulated as a bank. We can't say it's predatory lending, but they understand the asset better than any other bank. So if I was a private equity investor at $100 million, I'll do a private credit. And if you look at an asset class, and most people are going to go to multifamily and most going to be industrial. I'm contrarian. I will look at the maximum yields. I'll look at alternatives. Alternative asset class can be RV park, manufactured homes, data centers, things of that nature, because it's still esoteric, means it's still fragmented. Not too many institutional players are coming into that market. So there's a lot of small mom and pop, I'm going to call it lifestyle business owners. So they can come in and really take on those properties at the best value. So those are the two things I will look at: alternatives, private credit. I hope that answered it. If you found this content helpful, please subscribe, like, and add comments. Thank you.